If you are holding Singapore blue chips right now, you might be feeling a strange mix of relief and anxiety. You see the Straits Times Index inching up, you see green on the screen, but you probably saw the headlines about global volatility and wondered if this local rally is a trap. If you are sitting on cash, you are paralyzed by the fear of buying at the top. If you are fully invested, you are terrified that the 4% GDP forecast is just a number on a spreadsheet that won't translate to your dividends. It feels like the market is sleepwalking and you are worried that the moment you blink, the floor is going to fall out. But if you strip away the noise and look at what is actually happening under the hood of Singapore Inc., the story is completely different. The real story isn't about the daily price fluctuation of the index. It is about a massive structural shift where our biggest legacy companies, Keppel, Capitaland, and UOB, are quietly fortifying their businesses against the exact volatility you are afraid of. The headline says market closes higher. The real story is that Singapore's economic engine is being upgraded in real time, and the smart money is positioning itself for a multi-year run, not just a quick trade. This is a complex story of resilience, and today we are going to break it down. I am Iggy, your Singapore-based market analyst, and my job is to cut through the noise, ignore the sensationalist clickbait, and show you what really matters for your CPF, SRS, and SGX portfolios. And we have been putting in the work. Since October 2025, this channel has produced over 1,200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context so you can uncover hidden gems and potential pitfalls. Today, we are going to do exactly that with a deep dive, slide by slide, through the latest moves from 3 of Singapore's absolute giants to see if your portfolio is ready for 2025. First, let's look at the macro environment, specifically the Straits Times Index or STI. We saw the index climb 0.62% to close at 4,496.63. Now, to a casual observer, less than 1% seems like a rounding error. But let's analyze what is driving this. This upward tick isn't just random noise. It is largely driven by positive sentiment spilling over from Wall Street combined with a very specific, very important local catalyst. The government upgrading Singapore's GDP growth forecast for 2025 to a strong 4%. Why does a 4% GDP forecast matter to you as a dividend investor? Because GDP is the tide that lifts all boats. When the Ministry of Trade and Industry upgrades the forecast, they aren't guessing. They are looking at trade data, manufacturing output, and services revenue. A 4% growth rate implies robust lending for banks, higher occupancy for malls, and better sentiment for developers. It means the recession risk that everyone has been fear-mongering about for the last 18 months is receding. This provides a fundamental flaw for the STI. It tells us that the earnings of the companies you hold are supported by a growing economy, not a shrinking one. This is the bedrock of our thesis today. Now let's move to our first corporate heavy hitter, Keppel. The news is that Keppel is partnering with JTC to explore a new microgrid system in Singapore. They will be testing renewable energy sources and smart ways to manage power demand. Let's stop and define what this actually means. What is a microgrid? Think of the main power grid as a giant highway. A microgrid is like a self-sufficient estate that can generate, store, and manage its own electricity, often using solar or other renewables. If the main highway gets jammed, or in power terms, if the main grid fails, the microgrid keeps running. Why is this deal with JTC significant? JTC controls the industrial backbone of Singapore. By partnering with them, Keppel isn't just running a science experiment, they are auditioning to be the power manager for Singapore's industrial future. This feeds directly into the Keppel 2.0 narrative. Remember, Keppel is no longer just a rig builder. They are transitioning into a global asset manager and operator with a focus on sustainability. From Iggy's perspective, this is exactly what long-term investors should be looking for. This is what we call planting seeds. This specific project won't move the needle on their dividend yield this quarter. It might not even show up materially in the 2025 earnings report, but it is proof of concept. It shows that Keppel is actively pivoting toward the green economy, which is a massive secular trend. They are building a sticky business model. Once you install and manage a microgrid for an industrial park, that revenue is recurring and reliable. This isn't about a quick pop in the share price. It is about building a resilient, future-proof business. For long-term investors, this move strengthens the case for Keppel as a core holding that is aligning itself with the global shift towards sustainability. Next, let's look at Capitaland Investment, or CLI. The headline is that CLI is teaming up with a Malaysian developer to shape the retail strategy for a huge new mall in the Johor, Singapore Special Economic Zone. Let's break this down. First, the location, the Johor, Singapore Special Economic Zone. If you have been following the news, you know that the RTS link is nearing completion. The connectivity between Singapore and Johor is about to change forever. We are looking at a potential boom in cross-border flow. Singaporeans going there to spend, Malaysians coming here to work. This zone is set to be a major economic hub. Second, the role CLI is playing. Notice the language, shape the retail strategy. CLI is an asset manager. They prefer to be asset-light. They earn fees for managing assets, designing strategies, and optimizing tenant mixes, rather than just holding heavy bricks and mortar on their balance sheet that weighs down their return on equity. Iggy's perspective on this is simple. Smart money follows growth. The Singapore retail market is mature. It is saturated. If CLI wants to grow, they need to look outside. By planting its flag in the Johor SEZ, CLI is positioning itself to benefit from the increased cross-border activity without necessarily taking on the massive construction risk of building the mall themselves. This is a strategic play on regional growth. It shows the management is thinking beyond our shores to find new avenues for expansion. This is exactly what you want to see from a leading asset manager, capitalizing on the Singapore Plus One strategy, where growth spills over into our closest neighbor. It validates that CLI is not sleeping at the wheel, they are aggressive and opportunistic. Now let's move to the third pillar of today's analysis, UOB. The news is that UOB has priced 850 million euros worth of covered bonds. Let's define this, because covered bond sounds technical. Think of a covered bond as a very secure loan that the bank takes out. It is covered because it is backed by a specific pool of assets, usually mortgages. If the bank goes bust, the bondholders get those mortgages. Because it is so safe, the interest rate is low. UOB priced this at a coupon of 2.718%. Why does this matter? 2.718% is incredibly cheap money in today's environment. Compare that to the US federal funds rate or even local fixed deposit rates. UOB is essentially borrowing money at roughly 2.7% to turn around and lend it out at 4%, 5%, or 6%. This spread is their profit. Furthermore, the fact that they raised this in euros is crucial. It shows they are diversifying their funding sources. They aren't just reliant on Singapore dollar deposits. They can tap into European liquidity. From Iggy's perspective, do not let the financial jargon intimidate you. This is business as usual for a major bank, but it is a very positive signal. It shows that UOB has a rock-solid reputation. International investors in Europe are willing to throw nearly €1 billion at UOB at a low rate because they trust the bank's balance sheet. For shareholders, this isn't a signal to buy or sell today, but rather a confirmation of the bank's financial strength and stability. It is another brick in the wall of what makes our local banks such a reliable cornerstone for many dividend portfolios. It confirms that the dividend is safe because the bank has ample access to liquidity. So having looked at the STI, Keppel, CLI, and UOB, let's move to Iggy's assessment to wrap this up. What is working right now? The macroeconomic backdrop is working. A 4% GDP forecast provides a tailwind for domestic cyclicals. That means your banks, your property developers, and your consumer stocks. The corporate strategy is working. We are seeing our blue chips, Keppel, NCLI, making active pivots toward growth areas like green energy and regional expansion. They are not stagnant. The banking sector is working. UOB's ability to raise cheap funds proves that the system is flush with liquidity and trust is high. What is not working, or rather, what are the risks? The primary risk remains global. While Singapore is doing well, we are an open economy. If the US or China stumbles significantly, that 4% GDP forecast could be revised down very quickly. Specifically for CLI, the risk is execution. The Johor SEZ is promising, but cross-border projects are notorious for regulatory hurdles and delays. For Keppel, the risk is the pace of adoption. Green energy is the future, but the transition costs money and takes time to become profitable. In terms of valuation, the STI at around 4,500 is fair. It is not bargain basement cheap like it was a year ago, but given the growth upgrade, it is certainly not expensive. We are likely trading at a price-to-book ratio that is very reasonable compared to global peers, offering a yield of around 4-5% on average. So here's my final recommendation. For existing unit holders and shareholders of these blue chips, hold. The thesis is playing out. You are collecting dividends from UOB while they optimize their funding. You are holding Keppel as they transform into a growth engine. You are holding CLI as they tap into regional recovery. The yield is decent and the companies are executing well. There is no reason to sell into this strength unless you desperately need the cash. For new buyers, you need to be selective. I would not chase the index blindly at 4,500. However, UOB at current levels offers safety. If you are looking for growth and have a 5-year horizon, Keppel is a buy on dips. If you see a pullback in price, that is your entry for the green transition play. For CLI, I would wait. The Johor story is exciting, but I want to see concrete revenue numbers from these overseas ventures before backing up the truck. I would wait for a better risk-reward ratio or a slight pullback in price. The theme today is strategic positioning. We are seeing Singapore's corporate giants make quiet, calculated moves that won't necessarily make headlines, but are building long-term value. Your job is to identify these quality names and stay invested for the long haul. If you found this valuable and want to go deeper than the headlines every single morning, consider becoming a free or paid subscriber to the Investing Iguana Substack. We break down these complex topics every day so you don't have to. You will be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We are also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Your support keeps the lights on and keeps the analysis independent. Thanks for watching, keep your emotions in check, and I'll see you in the next analysis.